In this video, I'm going to talk about the myth about not having enough money. I'm going to try and dispel that myth, that you don't have enough money to get into commercial. A lot of residential investors say to me, I'd love to get into commercial, I really want to get started, but the entry point is too high. I can't get into that market without getting more money, and I'm here to dispel that myth. You don't need loads of money to be able to get into commercial property. You just need a strategy, and you need potentially some partners or different approaches to make it so that you can get in there. So I've actually got 6 things that might help you with that challenge. So the first one is sell some houses. That's what we did. We wanted to find that red hotel. We had to sell some of the green stuff so that we could buy a red hotel. That's how we got into commercial. We took some of the assets that we'd built some equity in, we sold them, we took that money, we invested in commercial. It may not work for you, but it worked for us. That was our entry point. When we got started, there weren't as many options as there are now, or at least not in my head there wasn't. But there are other options now. But just think about this. Why don't you start small? This is the second point. Some people think they have to spend hundreds and hundreds of thousands of pounds to get into commercial property. It's not that way. Why not start small? There's some benefits to that. Think about it. If you're trying to borrow money for commercial property, you maybe got a track record in residential but not in commercial, you go into the financial institution or indeed joint venture partners and say, I want to do commercial, here's a great business, a great deal, lend me the money. And if it's right up here, it's going to be more challenging. If the entry point is lower, then you may get more traction. And what we found was, with those smaller steps, those incremental steps, it builds up to something bigger. So when you go to a financer, one of the things they really want to know is, what's your track record? Well, maybe you're going to have to take a step back, approach it from a lower level to get into the market, to allow you to build up that street cred, the fact that you've done it, that experience that some of these lenders would like you to have. So sometimes starting small will allow you to grow into bigger things, but also, of course, is going to be less painful if things don't quite go the way you planned. So sometimes I come across students and people who want to get into this market who really have big aspirations and they want to start here. Just let's learn to walk first, and then we can get up to the running sprint. So start small. Make it so that you can learn fast, not learn painfully. So that's the second point. The third one is, of course, joint venture. Why not raise some money through partners? So when we started, we used our own money, but as we grew our portfolio, we did get joint venture money. And it is something that you can do on a project by project basis. Quite often in commercial, you may put in a special purpose vehicle for that one property, which gives you an opportunity to wrap around other investors, potentially some equity in that project without necessarily digging into your other portfolio or the rest of the stock that you have. But joint venture money can be very useful way of getting into the market and maybe allowing you to move in further up the chain, as it were. The fourth thing to consider is turn over the big deals. So I've mentioned before, I like to play cash flow from Kiyosaki. One of the things that you learn is that when you're networking with people around the table that have money, but not necessarily places to put it, why not turn over the big deals, get in the swim, learn about projects, and if they're too big for you, sell the deal on. Take the money, use it as a deposit for the next one. But by being in the swim, you're earning money, but also you're finding out how these bigger deals work. Which means eventually, when the right one comes along for you and it's the right time, you can take an equity stake in that one yourself. But by all means, carry on turning over big deals. Don't shy away from them because you don't think you've got the money. There may still be education in it, learning in it, and opportunity to maybe make some money by selling it on to people that you know who have enough money or are at that stage to take on that type of project. So keep turning over bigger deals. The fifth thing, why not find a building that has an income? So if the building has an income, you're either going to find a joint venture partner or a bank is going to find it easier to lend on that because of the serviceability. Serviceability is a real key factor that the banks look for. How easy is it for you to service this debt if there is no income? Can you cope with that? That's one of the key criteria that the bank look at There are other factors, of course, but that is actually really important to the banks. What is the serviceability? So if you get a building that has partial income, that's going to help offset that risk to the bank. So maybe when you're doing your search criteria of what type of project am I looking for, maybe you just need to make sure it's ones with income. That might be something you have to put into your strategy, and it might be when you're talking to surveyors, talking to people in the industry, that's the type of project you're looking for. Not necessarily total, fully let, partial income allows you to ease into that project with a little bit more comfort because there's an income coming in, but also there's still an upside by redeveloping the bit that's not let. So that's the fifth thing to consider. The final thing, though, to consider is the benefits of not having a lot of money. Because I'm sure some of you have been in the case where you've got some money from selling a deal or doing something in development, and then it's burning a hole in your pocket because you want to go and invest it. You know the opportunity cost for it sitting in your pocket is expensive. You need to go and get it working for you again. The problem is, when you're moving into commercial, if you're trying to invest money because it's there, it's burning a hole in your pocket, your choice of property, your risk factor may be slightly discolored by the fact that you need to spend this money. Whereas when you don't have a lot, or it's somebody else's and it's got strings attached, you're much more careful with how you're investing that money. I don't want you to be too careful you never invest it, of course, but actually not having loads of money makes you think out of the box, keeps you on the ground, and makes sure that you are justifying every single penny that's invested. Rather than having a huge pot that says, oh, I need some interest, I need to cover this opportunity cost, and going out to spend it because the motivation is to make sure it's invested rather than making sure you're getting the right investment. So there's 6 things to think about, okay? In that myth about there's not enough money, I don't have enough money, the barrier to entry for me is having enough money to get into this market. It's not too expensive. There are lower cost deals, lower than the price of a house, that you can get into this market. You don't need 50% deposit, as some would say. There are ways around that. But consider small deals to start with. Consider potentially joint venture money or joint venture partner money. Consider the fact that you could maybe sell some houses or some of the projects you already have to enter this market to try and spread the risk. So maybe some of the portfolio, and some of you may be considering selling anyway because the tax has changed, hasn't it, in residential? And you may be thinking, well, I'm not making as much money here now. I've got some capital in there, but the interest payments are not getting offset against my income. The tax is too high. Maybe the opportunity cost now is too high for that. If I sell this, I can invest over here where I don't have those challenges. The 4th thing to remember is turn over the big deals anyway. Be in the swim, find those projects. If they don't suit you, sell them on. But by looking for the projects, analysing the projects, and speaking to the people who maybe have the money for those projects, all those little touch points are going to help you in your journey. So don't ignore them. The 5th thing, find a building that already has income. Allows you to ease in there a little bit easier, makes it so the risk for the financial institution or the people that are lending you the money is a little bit less. They can see the serviceability is a bit more achievable. And then the final one is just to remember, look, if you don't have lots of money, treat it as there's a silver lining to this. Having the challenge to make sure that your money is reaching as far as it can, that you're not spending or overspending, that you're not buying a project just for the sake of buying it. You're actually buying stuff that fits your criteria of what you're trying to achieve over the next 5 years. And it's really important. And not having enough money might actually be something that makes sure you stick true to what you're trying to achieve. So I hope those 6 things help, and I'll speak to you next time.